Okay, let's dive right into this. Have you ever actually tried to wrap your head around infinity? It sounds like one of those concepts reserved purely for philosophers or theoretical physicists, right? But what if I told you that in finance, infinity is something we literally put a price tag on every single day? Welcome to this explainer on pricing infinity and how perpetual cash flows actually work. Today, we're going to unravel a mathematical paradox that's secretly running the global economy, behind the scenes valuing everything from real estate to university scholarships. So what is the exact price of infinity? I mean, it totally feels like a trick question, doesn't it? Because if an income stream pays you money forever, shouldn't its value just be, well, infinite? But actually, it's not. In the real world, an endless stream of cash has a very specific, finite, and calculable price today. And while the concept might seem a bit abstract at first, the math behind it is incredibly practical. The real secret to unlocking this paradox lies in a concept called a perpetuity. Now, what is that exactly? It's simply an annuity with payments that continue indefinitely. It is literally the promise of forever money. And in finance, we actually have the tools to value this endless stream of income, bringing that infinite horizon right back to a finite number you can practically hold in your hands today. All right, here's what we're going to cover today. We'll start with the promise of forever money, dive straight into the math of infinity, and then compare ordinary versus due perpetuities. After that, we'll apply these formulas to real-world assets, and then we'll finish up with the completely fascinating history of forever bonds. Okay, section 1, the promise of forever money. Let's move to demystifying perpetual income and see how this all builds. So when analyzing long-term assets, analysts inevitably hit a wall, right? We can confidently predict cash flows for the next 5 or maybe 10 years, but what on earth happens after that? Well, perpetuities are used as simplified models for valuing cash flows way beyond an explicit forecast horizon. Instead of doing this overwhelming, impossible, infinite series math, trying to add up every single projected payment until the end of time, we use the time value of money. Because a dollar received 50 years from now is worth far, far less today, those distant future payments eventually shrink down to almost zero in present value terms. And it's this powerful financial principle that allows us to discount an infinite stream of future payments into one crisp, finite present value today. Moving on to section 2, the math of infinity. We are making the infinite finite. And don't worry, the math here is surprisingly elegant and totally manageable. Here is the absolute magic formula for a level perpetuity. PV equals A divided by R. So PV is your present value. A represents the constant payment amount you receive each period, and R is the discount rate per period. That's literally it. You do not need an Ivy League degree or a supercomputer for this, just a standard calculator to divide the payment by the discount rate. The absolute crucial takeaway here is the relationship between these numbers. As your discount rate R increases, the present value actually falls. Why? Because a higher discount rate means all those future payments are being discounted much, much more heavily. Let's make this tangible for your own wallet. Imagine you're offered a contract that guarantees you a payment of $10 a year every single year forever. What would you pay for that today? Well, if your required discount rate is 10%, you just divide $10 by 0.10, and the answer is exactly $100. Think about that. For just $100 today, you have successfully purchased an infinite stream of $10 payments. It really is that straightforward. But wait, what if the payment isn't flat? What if it actually grows over time to keep up with something like, say, inflation? Well, that brings us to the growing perpetuity formula. PV equals CF1 divided by R minus G. Here, CF1 is the expected payment for the next period, and G is the constant rate of growth per period. Naturally, the present value goes up as that growth rate rises. But, and this is a big but, there is one golden rule you absolutely have to remember here. The discount rate R must be strictly greater than your growth rate G. Because if growth equals or exceeds the discount rate, the whole formula breaks down and mathematically implies an infinite value, which is just impossible in a functional market. All right, section 3, ordinary versus perpetuity due, because timing is everything. So the crucial point here is, exactly when do you get paid? There is a highly lucrative distinction we need to make. An ordinary perpetuity assumes payments are made at the end of each period, meaning your first payment arrives 1 year from now. But a perpetuity due means payments are made at the start of each period, which means you get your first check immediately, today. Because every single payment is received 1 period earlier, a perpetuity due mathematically has a higher present value than an otherwise identical ordinary perpetuity. To calculate it, you literally just take the ordinary formula value and add exactly one extra undiscounted payment today. Plain and simple, getting paid today always beats getting paid tomorrow. Let's pivot to Section 4, Valuing Real-World Assets. We're going to look at forever money in daily life, because these seemingly abstract formulas, they're quietly running the world all around us. Now, you might be wondering, who actually buys an infinite contract in the real world? Well, investors do it constantly. In corporate finance and equity valuation, the constant growth dividend discount model actually treats stock dividends as a growing perpetuity to figure out a share's terminal value. Or think about real estate appraisal. When an appraiser takes a single year's stabilized income and divides it by a market-derived capitalization rate, or a cap rate, they are using the exact algebraic form of a level perpetuity. Preferred stocks with fixed dividends and no maturity date, they use this framework too. Even university endowments, which are designed to preserve the principal while funding a scholarship indefinitely, rely entirely on this math. So yeah, these aren't just abstract classroom ideas. They are the absolute bedrock of asset valuation. And this brilliantly illustrates Section 5, Forever Bonds and Consols. Let's look at history's infinite payouts. If you want actual historical proof that forever money exists, look no further than British consols. These were government securities with absolutely no scheduled maturity date, designed to pay a fixed coupon forever. Their origins trace all the way back to the 18th century. To give you a super specific example, the government issued a really famous 4% console back in 1927. But it turns out forever actually did come to an end fairly recently. In the 2010s, the UK government decided to eliminate their remaining undated gilts. They announced the redemption of that 1927 issue in October 2014, and the final payout happened in February 2015. So after decades of infinite promise, the books were finally closed. Now, what's really interesting here is the sheer scale of it all. Prepare yourself for this number, £1.26 billion. That is the estimated amount of cumulative interest payments the UK government paid out solely on that 1927 4% console issue before they finally redeemed it in 2015. It's just a staggering testament to the power of infinite cash flows over time. It shows exactly why understanding the discount rate on a perpetuity is so vital, because if you're the one paying it out, it adds up incredibly fast over a century. And listen, perpetual instruments aren't just some quirky relic of British history. They're critically important to modern banking today. Under the Basel III capital rules, instruments eligible as additional Tier 1 capital for banks actually must be perpetual, meaning they have no maturity date. However, they do come with a modern, high-stakes twist. These modern perpetuities are often structured to absorb losses during a financial stress event, either through conversion or direct write-downs. So while they offer bond-like coupons, supposedly forever, this loss-absorbing feature actually makes them much, much riskier than conventional bonds. So we've basically covered the whole shebang today. Everything from the fundamental definition of an endless annuity, through the elegance of the math that makes infinity finite, all the way to real estate cap rates, historical government bonds, and modern bank regulations. Which leaves us right here. If you were offered perpetuity today, a guaranteed stream of income for the rest of eternity, what discount rate would you demand to price your own infinity? Think about how you value your time, your risk, and your future. Thanks so much for joining me on this explainer, and keep questioning the true value of tomorrow.